I've spent years crafting a crypto trading strategy backed by math, and today I'm giving it all away. Most traders lose because they're chasing hype or using highly risky strategies. Last year, this strategy made me over $225,000, and today I'm gonna show you exactly how you can copy it too. By the end of this video, you'll know how to trade with a mathematical edge, avoid costly mistakes, and use the cheat code Einstein called the eighth wonder of the world, compounding interest. So let's get started. Did you know that 90 to 95% of traders lose money? The world of trading has a certain allure that makes it hard to resist. I mean, who doesn't love the idea of making money right from home, just using a computer and an internet connection? Yet beneath the social media guru's facade lies the reality. Most traders lose money. But why? What separates the 5% who consistently profit from the majority who watch their hard-earned money disappear? So here's the thing. Most traders aren't failing because of bad luck. They're failing because of bad habits. Nobody ever taught them how to win. They don't use proven systems, trade based on emotions. They have no idea how to find an edge. These are just some of the things that I've found over the thousands of students that I've had in the 7 years that I've been teaching people how to trade. And let me tell you this, if you're watching this video right now and you do not have a mathematical edge, you're really not trading. You're basically gambling blindfolded and just hoping for the best. If this sounds like anything you're doing right now, then you need to watch the rest of this video. Just by avoiding the most common mistakes that I see people make, you will already get ahead of 90% of traders out there. So let's start there. So the first and most common mistake that I see is something that I'm sure we've all experienced before. You're scrolling through Twitter, Instagram, YouTube, and everybody's talking about some coin that's going to the moon. You see a chart, you see it's up 300% in the last 24 hours, and of course, FOMO kicks in. But by the time it's already circulating through social media, you're probably too late. You have to stop chasing the hype. Even if we look at Bitcoin right now, we see it's currently up over 8% in the last 24 hours basically. What happens is a lot of people are gonna see, oh, Bitcoin's going back up almost at $100,000 again, and now they're going to buy at this obvious resistance level. When the actual entry for this was when you saw it bounce here at this major support level for Bitcoin. But of course, at this point, there was a lot of fear in the market. Sentiment was really bad. We just had swept all the lows. So most people probably didn't want to enter there. Which brings us to our next mistake that I see a lot of people making: trading with emotions. Fear and greed are the two biggest enemies of any trader. Greed is what gets you into this bad trade right here. You see all these green candles and you think, if I don't buy now, I'm going to miss out. And fear is what makes you sell at the worst times. Here's the thing, the market wants you to be emotional. It feeds on your panic and your FOMO because emotional traders make bad decisions. And bad decisions means easy money for smart players. The next common mistake I've seen a lot of traders make, including myself, is leverage. Look, leverage isn't evil, it's a tool. But if you can't make money with no leverage, you will definitely not make money with leverage. Leverage basically amplifies whatever your results are. So if you're a winning trader, you can become a bigger winning trader. If you're a losing trader, you're gonna become a bigger loser. Leverage is a double-edged sword because it could completely wipe out your account. And the worst thing about trading is having to redeposit money into your trading account. And it's probably one of the worst feelings in the world when it comes to trading. And the final mistake that we're gonna touch on is probably the biggest mistake of them all: not having a strategy. This is where most traders lose before they ever even begin. The hard truth is, if you don't have a mathematically backed plan, you're just guessing. Think about it, trading is all based on probabilities. Probabilities is math. So why are you trading without using math? It literally makes zero sense. This is why 95% of traders are losing. You're playing a game and you have no idea what the rules to the game are. You're better off taking that money and going to your local casino and putting it on red or black because, I'm gonna be honest, you're gonna have a better shot at making money there than trading without a mathematical edge. You're trading against people like me who have been doing this for 10 plus years. We are literally here to take your money. Imagine these billion-dollar companies with thousands of employees, with mathematical degrees from Harvard and Stanford and all these Ivy League schools. They all have probably hundreds of years of combined experience put together, and then you're coming into the market with a gut feeling, blindfolded, no edge, no plan, no math, trying to compete with these people. This is something that I don't think the majority of traders understand. While you're working your full-time job, trading on the side as a hobby, you're going against professionals whose entire livelihood is making money and taking money from you. Have you ever watched those average Joes versus professional athletes videos where an average Joe thinks he can actually keep up with a professional athlete who does this for a living, who eats, breathes, and sleeps this? That's basically what you're doing when you come into this market. And that is why 95% of traders are not profitable. But here's the good news. I've spent the last few years creating a strategy that takes all of this into account. It's a system that takes advantage of the majority of the traders in the game that lose 90 to 95% of the time. And it's proven by my win rate across 183 trades last year. This system is backed by math and made last year one of my most profitable years to date. So last year I made over $225,000 trading crypto. Not by gambling, but by following a simple, repeatable strategy. Now, this isn't some secret formula or magic pill. It's math, probabilities, and sticking to a system that works. Because just like any other system, this system will lose some trades. You will have losing trades, you will have losing days, losing weeks, maybe even losing months. You can see I had 2 losing months back to back. At this point, most traders would have probably switched systems, maybe even quit trading altogether. But if you stick to your edge, then you will let the power of large numbers play out. And the best part of this system is that literally anyone can do it. So let's break it down. The first and most important pillar of this strategy is risk management. This is where most traders mess up, not just in this strategy, but any strategy really. Because without proper risk management, you're going to end up maximizing your losses and potentially blowing up your account. So I stick to a simple rule called the 5% rule. That simply means that in any one trade, I will never lose more than 5% of my capital. And although the rule is called the 5% rule, it doesn't mean you should be risking 5% on every single trade. That should just be the top end of your trades on trades that you're very, very confident in, high conviction in. Everything else should probably be within that 1 to 3% range. The reason I do this is because even if I lose this trade, it's just a small bump on the road, not the end of the journey. Let's say you have $10,000 in capital. And let's say you risked 15% on a trade. That would leave you with $8,500. Do that a few more times and you're going to have to redeposit into your trading account. And the issue is when people are down 15% of their account after one trade, they start to get emotional. So now you start to revenge trade. So now maybe this time you'll risk 20% of your account. Minus 20%. If you lose a second trade in a row, now you're down over $3,000 and over 30% of your account. Let's say you do that one more time. Maybe now you risk at this point 25%, right? Because you're still trading with the same exact size as when you had $10,000 instead of lowering your position size. So now you're gonna lose 25% if you go on a losing streak. And in 3 trades, just like that, you've lost half of your capital. Now let's go over this again, but using the 5% rule. Let's say we go on a 3 trade losing streak just like we did in the previous example. But this time we're only losing 3% at a time. So after your first loss, you'll lose $300. After your second loss, and notice we're doing 3% of our total capital, not 3% of $10,000 at this point. We would at this point be at $9,400. And after one more loss, that will put us around $9,100 at that point. So yeah, I might be down $900 after 3 losing trades, but I'm not down $5,000 or half my capital. So that's the first thing that you need to ingrain in your head, because risk management isn't just about protecting your money, you're also protecting your mindset. And having the right mindset when trading is half the battle. The second pillar in my strategy is high probability trades. This is what gives me an edge in the market. It's not about guessing, it's not about chasing trends. It's about stacking the odds in your favor just like casinos do. For me, this means looking at key metrics like delta and implied volatility. Looking at the exchange that I trade on, you can see the delta right here. I target ranges where the delta is below 0.3. So out of all of these trades available here, I'd be looking at this one here from 0.28 and below basically. This range gives me the perfect balance between risk and reward. So let's say you're selling a Bitcoin option with a delta of 0.22. That means that the market is telling you that you have a 78% chance that the trade will go in your favor. These are the kind of odds that I like to stack in my favor. So in this example, this contract here that expires on the 31st of January is currently paying $1,650 with a strike price of $89,000. So what that means is as long as Bitcoin's price stays above $89,000, I make $1,650 in profit by the expiration date. And the market is telling me that I have a 78% chance of being right. Most traders don't even know that this metric exists or what it even means. But when you begin to understand these metrics, it's basically like having a cheat sheet for the market. The market's literally telling you your probabilities of winning. The third pillar of this strategy is discipline. Sticking to the plan no matter what. This is where the majority of traders mess up, even if they have the first two pillars down. And this is usually what separates profitable traders from the other 95%. Discipline plays such a big factor that even if you and I are using the same exact strategy as I'm showing it to you right now, we most likely won't have the same results 12 months from now just based on discipline alone. Here's the thing, even the best strategy in the world won't work for you if you don't follow it consistently. Most traders are emotional, it's just human nature. It could be something as little as holding a position for too long, not cutting your losses while they're still small, risking more than you should. What may seem like small, tiny mistakes compound over time. When you stick to the plan, you remove emotions from the equation and you let the math work in your favor. This isn't theory, it's the exact strategy that I used last year to make the most profits I've ever made in a year. So in order to build discipline, you can get my 10 rules for passive income selling crypto options that you can look at before taking every single trade. I'll link this completely for free in the description below. I'm gonna show you guys real examples of exactly how I use this strategy to find consistent winning trades and how I use the 8th wonder of the world as a cheat code to grow my portfolio. So first off, if you guys don't know by now, I trade options and not just any options. I'm not buying options and betting on the price to go up or down. I am selling options to people who are buying options and betting on the price to go up or down. There's a few reasons for this. When you trade with leverage or buy options, you have to bet on the price to go up or down. And if you're wrong, you lose money. It's that simple, right? And I feel like that's where people struggle the most, trying to figure out where this is going next. Is it gonna continue to go up, go back to 100K, or is it gonna drop off and go back to $90,000, right? If you're a new trader, you pretty much have a 50-50 shot at being right. Here are my stats for when I trade leverage. I'm right about 67% of the time. Now, when you're selling options, you're taking out probably one of the hardest parts of trading. You're taking it out of the equation because now you no longer need to try to guess if price is gonna go up or down, right? Now what you're doing is picking a price point and an expiration date. As long as the price doesn't fall below your price point, you will make your profit. So for example, January 31st, $87,000 strike pays $1,200 in premium right now with a delta of 18. This tells me I have an 82% probability of winning this trade and collecting $1,200 in the next 2 weeks. So now it doesn't matter if price goes up. It doesn't even matter if price goes back down to this level that we just visited the other day. The only thing that matters is this level right here, which is $87,000. As long as the price doesn't fall below this level, which is my strike price, I collect this profit. It's literally that simple. So now that you know the framework, let me show you exactly how this works in real life. I'm also gonna show you guys exactly how I use math to have an edge in every single trade that I take, the formula that I use to size my positions and manage my risk, and then of course we'll finish with the cheat code that Einstein dubbed the 8th wonder of the world, compounding interest. So let's take a look at a recent position that I shared with my Discord group here, and we'll break it down together. So this was a Bitcoin sell put option alert with a strike price of $89,000 and the expiration date on the 31st of January. The entry bid was $1,740 or higher. And then our stop loss is between 1.25x to 2x the premium. So this basically means you take this number and multiply it by either 1.25x at the more conservative level, or 2x at the max. So that means that that would be the max you would lose per contract on this position, right? And then to keep it as simple as possible, I even do the calculations here for everyone to see. And it's up to you to choose the multiplier that aligns with your risk tolerance. Everybody's different. Now, the recommended position size was 15.83% of portfolio, and this is based on the Kelly Criterion. We'll get into this a little bit more in a second. That's basically a mathematical formula. I put a score here. This is just from my scoring model that I created, something that I'm still working on and refining right now. And then return on risk is 19.55%. So one thing that I actually did not write down here was the expected value on this trade, which is one of the formulas that I use to pick the optimal position size when I'm looking for a winning trade. But if we scroll up here to our previous trade, you can see that I did include it in this one here. EV per contract, $970. So let's talk a little bit about this. So EV stands for expected value. In every trade that I take, I'm always looking for positive expected value. So if you've played poker before, you're probably familiar with this term. It's a way to measure your odds of winning over the long run and then making decisions based on those odds. So for example, let's say that we're flipping a coin. A coin flip is 50-50, right? So your chances of being right is 50%. Now let's say that every time you win $3, and every time you lose $1. In this scenario, your expected value is positive because the potential rewards outweighs the risk. If you win 5 times and you lose 5 times, you would make $3 every time you won. So that's $15 plus lose $1 every time you lost. That's $5. So that's a positive expected value of $10, right? Now, if we flip the coin again another 10 times, you might only win 3 times and lose 7 times, right? So that would be $9 on your 3 wins minus $7 in your 7 losses. So overall, you still be up plus $2. However, your expected value would still be $10 because even though you only won 30% of the time, your win probability is still 50% over the long run. You just haven't done it enough yet. So the more and more you do it, the closer and closer you're gonna be to your actual expected value and your win probability. So now actually the more trades that we take with a positive expected value, the more we're stacking the deck in our favor over the long run. So next let's talk about the Kelly Criterion, which is the other math formula that we use in every trade that we set up. This is the formula that I use to find my optimal position size for every trade I take. Simply put, the Kelly Criterion is a formula traders use to figure out the best size for their trades to maximize long-term growth while also managing risk. It helps you avoid betting too much or risking ruin or betting too little and missing out on potential gains. Here's how it works. If your win probability is 60% and your loss probability is 40%, your edge is the difference between the two, which would be 20% in this scenario. Then you have to calculate the odds. This is a ratio of how much you could win versus how much you could lose. If you risk $1 to win $2, the odds are 2 to 1. Now, as you can see, it's a great tool, but it's not perfect. I would never risk 40% of my capital on a trade. So what I personally do is I use fractional Kelly. The key is that it balances risk and reward in a smart way to grow your portfolio. So going back to our first example here, where our position size was 15.83% of portfolio, when we actually look at what the risk is, once we bring in the stop loss into play, if this trade hit the stop loss while we were using a 1.5x stop loss, it would only be a 2.61% loss of my portfolio. So this ties it back to our 5% rule. If you guys remember, I never risk more than 5% on any one trade. And for the majority of my trades, I'm around 2 to 3%. This trade is right on the money. I'm only risking 2.61% of my portfolio if the stop loss is triggered on this trade. For every trade that I take, I literally follow this checklist. And I'm currently working on a scoring model basically that goes through all the available positions on Bybit and gives it a score. And I share all these scores in the Discord. As you guys can see here, I posted this one recently. And it's something that I'm still working on, still developing. But the idea is that this will help us pick the most optimal positions for every single trade that we take. If you guys are interested in joining the Discord so you can get these alerts from my scoring model, so you can see what trades I'm taking personally, and so that you can see this strategy in action, I'm currently offering a 7-day free trial, no strings attached, where you guys can try it for yourself. If interested, it'll be in the description below. Now, the final thing that I want to share with you guys is how I use these profits to compound interest. So let me tell you guys, this is literally a cheat code. Einstein called it the 8th wonder of the world, and once you understand it, you'll see why. So let me show you how it works. Let's say you start with $10,000 in capital. What we're currently doing is taking those $10,000 and making sure that they're in crypto. So it could be Bitcoin, Ethereum, Solana, any of your favorite cryptos. Then we're using those cryptos as collateral to sell options and collect a premium or profits, right? Now, as the value of those cryptos go up, the value of your portfolio also goes up. So if you started with $10,000 in crypto, let's say Bitcoin goes up 100% this year, your $10,000 is gonna be $20,000, right? That's without adding any profits into the equation yet. Now let's say you're making 10% per month in profits. We have to take the calculator out for this one. So first, let's look at a scenario where we're only compounding our profits. On average, last year, we did about 15% profit per month. So that's a 15% return on our capital on average, right? But let's be conservative and say that we only do 10% profit per month this year, right? In 12 months, our $10,000 would have turned into $31,000 if we averaged 10% return per month. That's a 213% gain. But we haven't even inserted the cheat code yet, because this is only one part of the cheat code, reinvesting your profits into your capital that you're using to trade. We're also reinvesting it into crypto. So now let's take a look at the scenario where I'm not only just compounding my profits back into my trading capital, but I also have all my capital in Bitcoin. All my profits are being reinvested into Bitcoin. And let's say in this scenario, over the next 12 months, Bitcoin goes up over 100%. Now it is kind of complicated to calculate what this scenario would look like. So I'm gonna use the help of ChatGPT, and we can see here that it says that if your initial 10,000 is entirely in Bitcoin and you compound your 10% monthly profits into Bitcoin while Bitcoin grows by 100% over the year, your total capital after 12 months would approximately be over $77,000. This includes the compounded growth of both your trading profits and the initial Bitcoin investment. And this is why I call this the cheat code, because just these numbers alone are unreal, right? 10% return per month is insane, but turning it into $77,000, now that's just ridiculous. But this is the potential of this strategy. So even though last year my total profits were in the realm of $200,000, my real profits, once you compounded last year's growth, was well over $500,000. I'm trying to show you the potential behind this strategy and this literal cheat code. You can literally go back to this video right here called How I Make $20,000 a Month Trading that I did 9 months ago, where I talk about this cheat code. This is probably the biggest cheat code that there is for growing your wealth during this bull run. It turns small, consistent wins into potentially life-changing money. But here's the catch. It only works if you're compounding into the right assets at the right time. Because as powerful as compounding is throughout bull runs, it can work against you just as fast when the market flips. So if you're not ready to flip your strategy when the market is also about to flip, you'll probably watch the majority of your profits vanish overnight. So in 2025, it's gonna come down to one thing: knowing when to flip from compounding into crypto to compounding into cash. And that's exactly why I'm planning to leave crypto in 2025, and you should too. And let's not confuse the message here. This is not about fear, it's about strategy. Timing your exit could mean the difference between starting over from square one or having life-changing profits. That's why I created an entire video just on this topic, explaining exactly when and why I'm going to exit crypto in 2025. So check out this video on why I'm leaving crypto in 2025 and why you should too. I'll show you exactly how to maximize your profits, avoid mistakes that most traders are probably gonna make, and walk away with everything you've earned. Trust me, you don't wanna miss this. I'll see you guys there.